The US dollar has been on a tear lately, reaching its highest level in 20 years against a basket of major currencies. One of the main drivers of this dollar strength is the Fed's aggressive rate hike cycle, which has made the US currency more attractive to investors seeking higher returns. But what does this mean for global trade and inflation? First, let's understand how the Fed's rate hikes affect the dollar. When the Fed raises the federal funds rate, which is the rate banks charge each other for overnight loans, it typically increases interest rates throughout the economy. This means that US bonds, deposits and other interest-bearing assets offer higher yields than those in other countries. As a result, investors from abroad sell their local currencies and buy US dollars to invest in these assets. This increases the demand for and value of the dollar. Second, let's see how a stronger dollar impacts global trade. When the dollar appreciates against other currencies, it makes US exports more expensive and less competitive in foreign markets. This can hurt US companies that rely on overseas sales, especially those in sectors like technology, manufacturing and agriculture. On the other hand, a stronger dollar makes imports cheaper and more affordable for US consumers and businesses. This can boost domestic demand and lower production costs for US firms that use imported inputs. Third, let's examine how a stronger dollar affects inflation. Inflation is the general increase in the prices of goods and services over time. A stronger dollar can have both positive and negative effects on inflation. On the positive side, a stronger dollar can lower import prices and reduce inflationary pressures from abroad. This can help the Fed achieve its inflation target of 2%. On the negative side, a stronger dollar can also dampen export growth and domestic demand, which can slow down economic activity and put downward pressure on prices. This can create deflationary risks and hurt the Fed's employment mandate. In summary, the Fed's aggressive rate hikes have boosted the dollar's strength against other major currencies and have significant implications for global trade and inflation. A stronger dollar can benefit US investors, consumers and importers, but it can also harm US exporters, producers and workers. A stronger dollar can also lower import inflation, but it can also create deflationary risks. The Fed will have to balance these trade-offs as it decides on its future monetary policy course. The dollar's outlook depends on various factors, such as the pace of economic recovery, the spread of new variants, the geopolitical tensions, and the policy divergence among central banks. The pace of economic recovery is uneven across the world, creating a divergent recovery that risks compounding pre-existing social cleavages and geopolitical tensions. The IMF projects cumulative global output losses from the pandemic of nearly $13.8 trillion through some countries have recovered rapidly from the economic crisis created by COVID-19, thanks to vaccination and digitalization, but many others are still struggling to avoid the worst consequences. The World Bank warns that a rise in inflation, debt, and income inequality could endanger the recovery in emerging and developing economies. The spread of new variants, such as Omicron, adds uncertainty and volatility to the global outlook. The new variant has caused a surge in cases and renewed restrictions in many countries, affecting consumer confidence and business activity. The IMF notes that considerable uncertainty remains about the path of the virus post-Omicron, including the durability of protection offered by vaccines or prior infections, and the risk of new variants. The World Economic Forum calls for broader efforts to fight economic long COVID by ensuring equitable access to a comprehensive COVID-19 toolkit with vaccines, tests, and treatments. The geopolitical tensions are also rising amid the pandemic, affecting trade, security, and cooperation. The World Economic Forum identifies several sources of tension, such as US-China rivalry, regional conflicts, cyber attacks, climate change disputes, and human rights violations. The IMF warns that these tensions could undermine global stability and growth prospects. The World Bank urges policymakers to avoid protectionist measures and foster multilateral dialogue to address common challenges. The policy divergence among central banks reflects the different stages of recovery and inflation pressures in different countries. The US Federal Reserve has started to taper its bond buying program and signaled that it could raise interest rates sooner than expected to contain inflation. The European Central Bank has also announced a reduction in its asset purchases but maintained a more dovish stance on interest rates. The Bank of England has raised its benchmark rate for the first time since 2018 to curb inflation. Meanwhile, many emerging market and developing economies have faced capital outflows and currency depreciation as a result of the tightening of global financial conditions. These factors have implications for the dollar's strength and direction. The dollar has appreciated against most major currencies since November 2021, reflecting its safe haven status and the expectation of higher interest rates in the US. However, some analysts argue that the dollar's rally could be short-lived if the Omicron variant dampens growth prospects or if other central banks follow suit in tightening monetary policy. Others suggest that the dollar could remain strong for longer if the US economy outperforms its peers or if geopolitical risks escalate. In conclusion, the dollar's outlook is influenced by a complex mix of factors that create uncertainty and divergence in the global recovery. The dollar could benefit from its role as a reserve currency and a higher yield advantage in the short term, but it could face downward pressure from weaker growth or stronger policy responses in other regions in the medium term.